Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hey, Jim.
Well, the U.S. jobs report last week looked terrific, especially compared to Canada, where we lost 71,000 jobs. The only job creator was in British Columbia, 13,000 jobs added there. But in the U.S., 275,000 jobs. That sounds terrific, but was it?
Yeah, we have this little game that we play in the U.S. with our jobs reports, where they always report a really good headline number, and everybody gets all excited and starts talking about the recovery gaining steam, and we're out of the woods, and we're growing organically, yada, yada. And then the analysts look over the actual numbers that the government reported and find out that it wasn't nearly as good as what they thought. Usually, what happens is that all the jobs that were created are part-time jobs, and so the government counts all jobs, including part-time jobs, as jobs, but there's a big difference in the real world between a part-time job and a full-time job, and that's the thing that gradually makes the numbers look a lot less stellar than they did at the beginning. This time around, there was just this massive seasonal adjustment where in previous months, in previous years' months, in the back, going backward, the seasonal adjustments were pretty minimal, and this time around it was hugely positive, of course, from the government's point of view. So it gave the headline number a lot more gloss than it would have had. And yet, we're still adding part-time jobs, and most of the new jobs coming in are going to people over 55, who are basically people who probably didn't intend to be entering the workforce as a bartender or a waiter or some kind of healthcare orderly at this point in their lives, and yet they are to make ends meet. So it's still not nearly as good as it looks. And, you can pretty much say that about any aspect of the U.S. economy. We aren't growing the way we have in the past, certainly not considering the fact that interest rates are so low. And the government is running still big deficits and creating lots of new currency. There's a huge monetary wind at the back of the U.S. economy, and it's not really having much effect, which is normal, or at least intuitively understandable, for when you borrow too much money. If you're too deeply in debt beyond a certain point, then growing gets hard and politics gets hard, and that's what we're seeing right now in the U.S., where really nothing is working the way it used to. And you can trace it directly back to the fact that we've been borrowing huge amounts of money year after year after year for 30 years now. So, one other really interesting thing, speaking of interest rates, that came out this week is that, U.S. Treasury bonds have positive yields, which set them apart from the bonds of Germany and Japan and Switzerland and a lot of other big countries. But it turns out that in other countries like Japan and Germany, where, let's say, an insurance company is going to buy treasury bonds to get that high yield, you also have to hedge against currency fluctuations in order to guarantee the return, which is what those guys have to do. And the hedging costs of dollars versus local currencies in Europe and Japan are going up to the point where treasury bonds now have negative yields there too. So we've joined the negative interest rate club everywhere but here within the U.S., and the rest of the world now has several trillion more dollars worth of negative yielding bonds to do something with out there. So this is potentially catastrophic for a lot of finance companies that need positive yields. Because if you're an insurance company or a pension fund, the fixed income part of your portfolio needs to generate a predictable, fairly respectable positive yield going forward. And that's not the case anymore. Yields are pretty much negative for government debt anyhow. And it's leading these big institutions to go out on the risk spectrum and start buying corporate debt, which in turn is leading corporations to issue lots of new debt because it's got a lot of buyers out there. So you're seeing big companies leverage themselves to the hilt in order to sell their debt to people who are desperate for yield. And they don't know what to do with the money. So they're basically, in the U.S., buying back their own stock at record high levels in a lot of cases. So that's a classic case of monetary manipulation distorting the price signaling mechanism of markets and leading to malinvestment. Because you could argue that IBM buying back $100 billion worth of its stock, actually, let's say $20 billion, which is more realistic, I think, recently, at a historically high price, that's malinvestment. They're buying stock that really isn't worth the price they're paying for it. And so they're, to an extent, wasting the money that they're receiving by borrowing money. And you're seeing that across the board among major corporations. And you're also seeing a lot of M&A where companies are buying out their competitors at record high prices again. And those things usually don't work out. Peak of the cycle, gigantic acquisitions at extremely high prices usually end up being, first of all, a signal that the cycle is ending, and second of all, this albatross around the neck of the company doing the acquiring that takes them years and years and regime change at the top of the company in order to work their way through. So, we're seeing stuff that we've seen in the past that ended badly just be repeated, only on a much, much vaster scale because it's global now. Everybody's got incredibly low interest rates or negative interest rates, and everybody's big companies and governments are borrowing too much money and misspending a lot of the proceeds. So, very bad thing is going on out there in the world, Jim.
Well, all these dynasties in the past, the Egyptians, they ran their show for 5,000 years. The Chinese, well, they're still going. The Romans went for about 2,000 years. None of them ever charged negative interest rates. I think there's a reason why.
Yeah, negative interest rates are a perversion of the concept of interest rates because that's the price you pay in order to get money from somebody for a given amount of time. And the person giving you the money is giving up the use of that money and taking the risk that you're not going to pay them back. So the interest rate that you pay is what equalizes the deal. In other words, that's enough to make it worthwhile for the owner of that money to give it to you for a while. Well, now, if they have to pay you in order to take their money off their hands, what does that mean? That's not a functioning market anymore. And it leads to all kinds of distortions that we're just now kind of figuring out. It's pretty clear from growth rates around the world that we're not getting the rip-roaring boom we thought we were going to get, or that Keynesian theory says we should get, from extremely low interest rates and negative interest rates. If somebody's paying you to borrow, you should borrow a lot, right? And that's not really happening, at least at the individual level. Companies are borrowing lots of money. They're responding that way, but all they're doing is buying back their stock. They're not building new factories or anything, and, or they're buying each other out. So we're not seeing an increase in the productive capacity of the world flowing from all this borrowing. And then for individuals, to the extent that we're borrowing money as individuals and families, we're maxing out credit cards in order to pay our day-to-day bills, or we're taking on student debt in order to put our kids through college, or we're taking out a big, long car loan in order to buy a new car that we probably don't need. We could probably get by with the car that we had for another few years, and yet money is so cheap, and they're willing to give it to us for such long periods of time that a lot of people are being suckered into buying new cars. Well, none of that is productive, right? A student loan, especially given the prospects for a lot of college graduates now, is not a productive use of capital in a lot of cases. And certainly, borrowing money to buy a car, which is a depreciating asset, isn't productive. And worst of all, putting money or putting debt on your credit card in order to pay your day-to-day bills is definitely not productive. And that's the situation that most of the world finds itself in. So this is an experiment that is ongoing, but is already showing signs of not working the way its proponents hoped and expected that it would work. So I think 2017 is going to be a year in which we recognize that what we've done so far isn't working, and that we try something even more extreme. So get ready for some really interesting economic theater in the months and maybe the years ahead.
Canada's the Bank of Canada Governor Stephen Poloz keeps making noises about negative interest rates for some reason. And of course, there've been a disaster in Japan, there've been a disaster in Europe. Why would you invite that disaster to come to North America?
Well, you would do it because you have no other tools. If things are slow and the economy doesn't seem to be working, central bankers and today's Keynesian politicians basically just know this one thing. You cut interest rates and you print a lot of new money and you run a big deficit. They just know easy money as their response to anything that isn't ideal. And so the fact that interest rates are way down doesn't really deter them. They're going to push interest rates down because that's their only tool. It's like the old saying that if your only tool is a hammer, every problem looks like a nail. And that's the way these guys view the world. We've got all these structural problems, and we've got massive amounts of debt that's out there that we can't get rid of. And they ignore all of that, and they just see that growth of consumer spending is somewhat slower than it should be. Therefore, you cut interest rates, And so it won't be a surprise to see Canada have negative interest rates pretty soon because so much of the rest of the world has already done it. Europe, at least in terms of German debt, is almost all negative yielding. And now rates are falling for a lot of the other European countries, like Italy's debt is getting cheaper and cheaper. And Japan, of course, and Switzerland. And so there's something like $12 to $15 trillion of negative interest rate debt out there. And it didn't work. So definitely expect to see that come to other places. Could be Canada, could be the U.S. in the year ahead, could be both. No way to know. But it's coming one way or another for most people in the world.
Well, if they're going to charge you for your money, won't people just go and empty their bank account and stuff their money in a home safe?
Yeah, beyond a certain point, that's the rational thing to do.
That's what's happened in Japan.
There are costs associated with holding your own cash because that's risky, and you need that safe. You need to go out and buy a fairly expensive safe. So if you include that cost, then you're paying a negative interest rate by holding your cash at home. And so people don't automatically do that when rates hit zero. But they, at the margin, do it more and more as rates fall. So as rates become more and more negative, more and more people choose to hold cash themselves. You're seeing a lot of big companies start threatening to do that pretty soon, too. The banks are starting to either charge their corporate customers negative rates on cash balances or threaten to do so. And you're seeing a lot of companies say, well, we'll just rent a vault. We'll put our cash in there. And so, this is bad. This is a real distortion of the way smooth operating markets used to function. And it seems to be that it's only going to get worse from here. And the reason that it's only going to get worse is that as companies and governments, and to an extent individuals, borrow more and more money at variable rates. That is, at either very short term, so they have to roll it over all the time at whatever rate is prevailing, or at some kind of a rate that is tied to some underlying interest rate like LIBOR or the prime rate or whatever. As more and more debt is taken on those terms, if interest rates go back up, that causes interest costs to go through the roof for a lot of these borrowers. So you would see countries go bankrupt if their if their interest rates went back up, or you would see central banks respond to that by basically just monetizing all the debt in the world. And either one of those things carries a lot of risks. The first carries the risk of a depression, when governments start defaulting on their own debt or becoming unable to cover their interest costs. And the second is potentially really inflationary. Complete monetization of government operations is usually the thing that precedes a hyperinflation, at least in the past. So, that's how Weimar Germany blew up its currency, and that's how Venezuela did it now, and Zimbabwe, and name your past hyperinflation. It usually happened because governments couldn't get enough money to be able to spend as much as they wanted to, so they just had the central bank create huge amounts of new currency, basically financing the governments directly. And now the whole world is doing it.
Well, look at Venezuela. Venezuela is so broke it can't afford to buy the paper to print its own currency.
Yeah, and its people are hunting cats and dogs for food and breaking into zoos and eating the zoo animals. Yeah, this is a catastrophe there, and it's you can trace it back to the economic policies of the past decade, in which the government spent too much money, borrowed too much in order to cover its spending, and eventually completely ran out of the ability to finance itself. So now it's destroying its currency. That's, when you tell people, oh, we're Venezuela or we're Zimbabwe, they tend to laugh at you because we're in a lot of ways not Venezuela or Zimbabwe, but we're making the same mistakes, and the laws of economics and finance don't really care whether you're a developed country or an emerging market. They apply either way. And so eventually those laws are going to come back to bite us one way or another. And it could well be pretty soon, because we're really just, by any historical measure, amazingly over-indebted, amazingly financially fragile. And so it's a question of what blows up to set the chain reaction in motion. And those European banks, boy, I keep coming back to those, but the Italian banks are a total mess. And recently some reports have come out about how Deutsche Bank, among others, among the big, formerly solid European banks, are in pretty bad shape too. And so it could be some big name that shocks everybody getting into trouble first, or it could be a bunch of no-name Italian banks blowing up all at once. But something like that is coming, and then the response of the central banks will be to just basically buy up everything, and then we'll see how the currencies that are being inflated away react. So
if Stephen Poloz, the governor of the Bank of Canada, brings in interest rates, what he's really doing is inviting you to eat your zoo animals.
He's inviting you or your kids to do so, depending on when the crisis hits. We don't know when it's going to happen, but we're traveling down that path, and bad things happen when you go too far down that path. And arguably, we're already so far down that path that we've passed the point of no return, and now it's just a question of how does this play out specifically. It's going to be bad, but you don't know what the specifics are going to be. And that's kind of what we're just witnessing now. We'll see over the next couple of years that bad things will happen. They might be things that you and I can predict based on what we know now, or it might be something just out of left field. But we've kind of created the conditions in which some kind of a crisis that metastasizes from wherever it starts to the rest of the world is virtually guaranteed.
We'll have more with John Rubino right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with John Rubino. Well, now that we've talked about the negative side of economics, let's talk about the positive stuff that's happening with gold and silver.
Yeah, this is one of those best of all all possible worlds for gold and silver right now. You got negative interest rates around the world, which is very good for forms of money like gold and silver that don't pay any interest. Because now, not paying interest is actually better than what a lot of cash does, and a lot of bank accounts do. And so, whereas gold used to be at a big disadvantage in terms of cash flow, it now looks pretty good compared to a lot of government bonds. So that is supporting the price. Meanwhile, you've got governments realizing that negative interest rates don't work and talking about ramping up deficit spending, which is also good for gold and silver. That's the kind of thing that, in that kind of a really loose environment, people tend to look for what they think of as inflation hedges, and precious metals are in that category. And oil prices are down, because oil is one of the major costs of mining gold and silver, that's improving the margins of a lot of the gold and silver miners. All of a sudden their costs are going down at the same time the stuff they're selling is going up, and you're seeing some really nice earnings reports from the gold and silver miners. They're reporting surging cash flow, plunging costs, and much higher earnings, and their balance sheets are getting better at the same time. So there's now more M&A going on in the gold market where bigger miners are buying out smaller miners. And they're reporting good numbers that make them look like growth stocks. So you're seeing them start to appear on the radar screens of investors who weren't normally interested in stuff like gold mining, because suddenly they've got earnings momentum and they've got price momentum. So the momentum trade now likes gold and silver. And so that gives this rally legs, very probably. It doesn't mean that there won't be a big correction here, because they've had a huge run so far this year. There's a lot of the bigger companies have tripled, and a lot of the smaller ones have quintupled, and that's the kind of thing that usually precedes a correction, because you can't have something just run and run and run forever without a lot of people wanting to take profits, and then spooking the momentum players temporarily and having it go back down. So it wouldn't be a surprise to see gold and silver miners correct from here, but that wouldn't change the underlying conditions, which are very positive. So a correction here is a buy the dip kind of signal. And that's what you see in bull markets. You notice that the dips are short and shallow, because there's a lot of people on the sidelines waiting to buy on that dip. And I think that's what we'll see in gold and silver going forward. We might see a correction here, but the correction won't be a catastrophic kind of thing like we saw in 2008 heading into the crisis, and that we lived through from 2011 to 2015. It's not going to be like that. It might be scary for a week or two, but then so much buying pressure will come in that it'll go right back up. And so that would be my advice to people. If these things correct, then consider it a buying opportunity. Figure out the things that you'd like to be in 20% cheaper, and be ready to grab them when they get to that point.
John, thank you so much for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.